ChatGPT just gave a specific number for silver on February 28, 2026. $86 per ounce. Not a range, not a vague directional bias, a precise target. And before you dismiss this as just another AI forecast, understand what's happening here. When a large language model, trained on millions of data points across financial news, market sentiment, technical patterns, and structural fundamentals, converges on a specific price target 3 weeks out, it's not guessing. It's synthesizing signals that the market itself is broadcasting, but that most participants are either ignoring or don't understand. Because here's what matters, more than the number. It's the structural logic behind why any predictive system, whether algorithmic or human, is now pointing toward continued upward pressure in a commodity that just experienced the most violent volatility in modern history. And if you're following this channel, hit that subscribe button right now, because what I'm about to show you is not speculation. It's the mechanical breakdown of why silver's path to $86 or higher is not a bullish fantasy. It's the logical extension of forces that are already locked into motion and accelerating. As of February 6, 2026, silver is trading at $76 per ounce, up more than 8% on the day. That's a sharp rebound from earlier in the session, when the metal plunged nearly 10%, and it's rebounding from a prior trading day where it dropped over 19%. That kind of intraday volatility is not normal for a commodity with $1.4 trillion in annual industrial applications. That's not sentiment-driven price discovery. That's a market structure under extreme stress, where liquidity is so thin that even modest order flow creates cascading price swings. And the ChatGPT model explicitly warned that the path to its 86 to target will not be smooth. It will be choppy, marked by continued volatility spikes. But here's what the model also concluded. Despite the violent swings, the base case scenario sees silver trading between $75 and $90 per ounce by February 28th. In a bullish scenario supported by softer US dollar pressure, easing rate expectations, and strong industrial demand, the range extends to $90 to $100 or above. In a bearish case, the model acknowledges that silver could sink below $75 if momentum fades or renewed risk-off flows dominate. But when forced to narrow the range and provide a specific figure, the model settled on $86. That's the midpoint of the base case, which tells you the model is weighting the bullish and bearish probabilities and concluding that structural support outweighs downside risk. Now, let's talk about why that conclusion makes sense from a causation standpoint, because this is where the mechanics reveal themselves. The silver market is caught in a structural trap that has no clean exit. On one side, you have a persistent supply deficit that's been running for 5 consecutive years. Global silver demand has exceeded total mine and recycling supply every single year since 2021, creating a cumulative shortfall of over 800 million ounces. That's more than an entire year of global production that's been pulled from above-ground inventories. And those inventories are nearly exhausted. In 2025 alone, the deficit was estimated at 230 million ounces. For 2026, analysts project the deficit will narrow to around 140 million ounces. But here's the critical point. It's still a deficit. Supply is still not meeting demand, and the narrowing is based on assumptions about increased recycling rates and marginal mine output gains that may not materialize. Given declining ore grades, operational disruptions in major producing countries like Mexico and Peru, and geopolitical risks across the supply chain. Even if the deficit narrows, it doesn't solve the problem. It just slows the rate at which the problem compounds. And every ounce of deficit has to come from somewhere. It comes from stockpiles, from COMEX inventories, from central bank holdings, from scrap recycling. And when those sources dry up, prices have to rise to ration remaining supply. That's not speculation. That's supply-demand mechanics operating exactly as they always have. Here's where the causation becomes even more unavoidable. Industrial demand for silver, particularly from the photovoltaic solar sector, has exploded over the past decade. From 2015 to 2024, silver demand from solar panel manufacturing increased by 289%, rising from 60 million ounces to 232 million ounces annually. That's an additional 172 million ounces of structural, non-cyclical demand driven by the global energy transition. And that demand is not slowing down. It's accelerating. Governments worldwide have committed to decarbonization targets that require massive build-outs of renewable energy capacity. Solar installations are expanding at record rates, and silver is irreplaceable in photovoltaic applications. There's no substitute material that matches silver's electrical conductivity and efficiency in solar cell manufacturing. So when ChatGPT factors in strong industrial demand as a bullish driver, it's not talking about cyclical economic activity. It's talking about policy-driven structural demand that's baked into the next decade of energy infrastructure investment. And that demand is price inelastic. Solar manufacturers will pay whatever they need to pay to secure silver supply, because the cost of silver in a solar panel is a small fraction of total panel cost. And without silver, the panel doesn't work. That creates a demand floor that keeps rising regardless of short-term price swings. Now layer in the supply shock from China. On January 1st, 2026, China implemented export controls on silver, classifying it as a strategic dual-use material and requiring export licenses for any company that wants to ship refined silver out of the country. The licensing criteria are deliberately restrictive. Companies must produce at least 80 tons of silver annually and maintain $30 million in credit lines. That consolidates control over 60 to 70% of global refined silver supply into the hands of a few large Chinese state-connected firms. Why would China do this? Because silver is a critical input for semiconductors, advanced electronics, solar panels, and military applications. By restricting exports, China preserves domestic supply for its own industrial base, while simultaneously weaponizing Western dependency on Chinese refined silver. This is resource nationalism, and it mirrors exactly what China did with rare earth elements. The impact on global supply is immediate and measurable. Since the restrictions took effect, silver lease rates in London and Zurich spiked above 8% on a one-month basis. That's a cost of financing signal that screams physical shortage. When it costs 8% annualized to borrow silver for 30 days, it means physical metal is not available at current prices. And COMEX registered inventories, the silver that's actually deliverable against expiring futures contracts, are collapsing. As of mid-January 2026, COMEX reported total silver inventory of 474 million ounces. But the vast majority of that is eligible inventory, which is metal sitting in approved warehouses but not registered for delivery. Registered inventory, the metal that can actually be delivered to settle contracts, stood at approximately 127 million ounces. And analysts tracking warrant movements estimate that truly available, unencumbered registered silver is closer to 28 million ounces. 28 million ounces. That's all that's effectively free and available on the COMEX. And in the first week of January alone, the exchange delivered 33.45 million ounces. March is the largest delivery month of the year, and the March contract currently has open interest representing 507 million ounces in notional exposure. If even a small fraction of those contract holders demand physical delivery instead of rolling their positions forward, the exchange doesn't have the inventory to meet that demand. The system breaks. And when the system breaks, you get one of two outcomes. Either prices spike to ration scarce physical supply, or the exchange declares force majeure and settles contracts in cash. Either outcome validates the thesis that paper silver and physical silver are decoupling, and that the futures market price is an artifact of leverage that only works as long as nobody actually wants delivery. Now connect this to monetary policy, because the Federal Reserve stance is the third structural pillar supporting ChatGPT's bullish bias. The model explicitly cited softer US dollar pressure and easing rate expectations as bullish factors. And that's exactly where the Fed is positioned. As of early February 2026, the Fed has signaled a gradual easing bias. New York Fed President John Williams stated that monetary policy is well positioned and indicated no near-term urgency for aggressive cuts. But the implied path from Fed communications and market pricing suggests 125 basis point cuts over 2026, bringing the federal funds rate from around 3.625% down to roughly 3.2% to 3.4% by year-end. That's a shallow easing cycle. But here's what matters. Even shallow easing in a structurally inflationary environment creates negative real rates for non-yielding assets. Silver doesn't pay interest. Its attractiveness depends entirely on the opportunity cost of holding cash or bonds. When nominal yields fall, but inflation expectations remain sticky around 2.5% to 2.7%, real yields compress or turn negative. And that makes hard assets, gold, silver, commodities, relatively more attractive. But there's a more important second-order effect. When central banks ease, they signal to markets that they prioritize growth and financial stability over inflation control. They're telling you they're more afraid of recession and debt service stress than they are of prices rising. And when debt-to-GDP ratios are at historic highs across developed economies, that preference becomes structural. Central banks cannot afford to tighten aggressively because the debt burden makes higher rates economically and politically untenable. So even if inflation stays above target, policy remains accommodative, and that accommodation debases fiat currency, which drives capital into tangible assets that cannot be printed. Silver, as the poor man's gold, with industrial utility, becomes a dual-threat asset. It benefits from monetary debasement and from structural industrial demand growth. Those two forces compound each other. Here's the part that pulls it all together. The structural deficit, the Chinese export restrictions, the collapsing COMEX inventories, and the accommodative monetary policy are not independent variables. They are mutually reinforcing feedback loops. The deficit creates upward price pressure. Higher prices incentivize marginal mine production, but those projects take years to come online, and ore grades are declining. Meanwhile, China's export controls artificially tighten supply to Western markets, amplifying the physical shortage. That shortage forces industrial users and investment buyers to compete for scarce metal, which drives prices higher and increases delivery demand on futures exchanges. Increased delivery demand drains COMEX inventories, further raising the risk of delivery failure or force majeure. That risk premium gets priced into futures contracts, creating backwardation or extreme contango. And all of this happens while the Fed signals it will not allow a severe contraction, which means monetary conditions stay loose relative to inflation, which debases the dollar and makes hard assets more attractive. Every link in the chain reinforces the next. There is no natural relief valve. There is no policy lever that simultaneously alleviates the supply deficit, reverses Chinese export restrictions, restocks COMEX inventories, and tightens monetary policy without triggering a recession. Policymakers are trapped. So what does this mean for ChatGPT's $86 target by February 28th? It means the model is synthesizing these structural forces and projecting their logical extension over the next 3 weeks. February 28th falls roughly 3 weeks before a first notice day for the March COMEX contract, which is the moment when contract holders must decide whether to take delivery or roll forward. That's the pressure point. That's when the market discovers whether 28 million ounces of effective registered inventory can meet delivery demand from contracts representing 507 million ounces of exposure. If delivery requests spike, the exchange either sources metal from eligible inventory, which requires voluntary conversion by vault holders, or it settles in cash. If it settles in cash, COMEX pricing integrity collapses and physical silver decouples from paper. If it sources metal and inventories drop below critical thresholds, prices spike to ration remaining supply. Either way, late February into early March is when this structural tension comes to a head. And ChatGPT's model is identifying that inflection point based on delivery calendar mechanics, inventory data, sentiment signals, and volatility patterns that all converge on the same conclusion. The paper market and the physical market are on a collision course, and the collision happens in March. The volatility we're seeing right now, the 19% daily drops, the 10% intraday swings, is not random noise. It's the market structure fracturing under the weight of contradictory forces. Leverage speculators are being forced out by margin hikes and volatility spikes. Passive index rebalancing is dumping paper contracts. But physical buyers are stepping in every time the price dips, because they understand that the underlying supply-demand imbalance hasn't changed. Industrial users need silver to manufacture solar panels and electronics. Investment buyers want hard assets as insurance against monetary debasement. And both groups are competing for a shrinking pool of available metal. That creates a price floor that keeps rising even as paper markets experience violent shakeouts. And that floor is what ChatGPT's base case is anchored to. The model isn't predicting that silver will smoothly rise to $86. It's predicting that despite violent swings, the structural support from the supply deficit, industrial demand, and monetary accommodation will keep the price elevated and push it toward the upper end of the range by month end. Here's the blunt reality. If you're holding physical silver, you're holding an asset that's structurally mispriced relative to its scarcity and utility. The futures market price is an artifact of leverage and paper contract trading that assumes infinite liquidity and perfect substitutability between paper claims and physical metal. That assumption is breaking down in real time. If you're trading silver futures or ETFs, you're exposed to counterparty risk and the possibility that your position is a claim on metal that may not exist or may not be deliverable when you want it. And if you're ignoring silver entirely because you think it's too volatile, you're missing the fact that this volatility is not speculative noise. It's the market repricing a structural imbalance in real time. ChatGPT's $86 target is not a prediction in the traditional sense. It's a synthesis of structural signals that point to continued upward pressure over the next 3 weeks, despite short-term turbulence. The mechanisms are in place, the incentives are clear, the policy constraints are binding, and the timeline is accelerating. The model identified the number. The question is whether you understand the causation behind.